One Big Beautiful Bill Act, OBBBA, includes numerous provisions affecting the tax liability of U.S. businesses. For many businesses, the favorable provisions outweigh the unfavorable, but both kinds are likely to impact your tax planning. Here are several provisions included in the new law that may influence your business's tax liability. Qualified Business Income, QBI deduction. The Tax Cuts and Jobs Act, TCJA, created the Section 199A deduction for QBI for owners of pass-through entities, such as partnerships, limited liability companies, and S corporations, and sole proprietorships. The deduction had been slated to expire after 2025, putting many business owners at risk of higher taxes. The OBBBA makes the QBI deduction permanent. It also expands the deduction limit phase and ranges for specified services, trades or businesses, and other entities subject to the wage and investment limitation. For these businesses, the deduction is reduced when taxable income falls within the phase-in range and is eliminated when taxable income exceeds the range. The new law expands the phase-in thresholds from $50,000 to $75,000 for individual filers and from $100,000 to $150,000 for joint filers. The OBBBA also adds an inflation-adjusted minimum QBI deduction of $400, beginning in 2025. It's available for taxpayers with at least $1,000 of QBI from one or more active businesses in which they materially participate. Accelerated bonus depreciation. The OBBB makes permanent 100% first-year bonus depreciation for the cost of qualified new and used assets acquired and placed into service after January 19, 2025. Under the TCJA, the deduction was limited to 40% for 2025, 20% in 2026, and 0% in 2027. The new law also introduces a 100% deduction for the cost of qualified production property, generally non-residential real property used in manufacturing, placed into service after July 4, 2025, and before 2031. In addition, the OBBBA increases the Circular 179 expensing limit to $2.5 million and the expensing phase-out threshold to $4 million for 2025, with each amount adjusted annually for inflation. Together, the depreciation changes are expected to encourage capital investments, especially by manufacturing, construction, agriculture, and real estate businesses. And the permanent 100% bonus depreciation may alleviate the pressure on companies that didn't want to delay purchases due to a smaller deduction. Research and experimentation expense deduction. Beginning in 2022, the TCJA required businesses to amortize the SECO 174 research and experimentation (R&E) costs over 5 years if incurred in the United States or 15 years if incurred outside the country. With the mandatory mid-year convention, deductions were spread out over 6 years. The OBBBA permanently allows the deduction of domestic R&E expenses in the year incurred, starting with the 2025 tax year. The OBBBA also allows small businesses, those with average annual gross receipts of $31 million or less, to claim the deduction retroactively to 2022. Any business that incurred domestic R&E expenses in 2022 through 2024 can elect to accelerate the remaining deductions for those expenditures over a 1 or 2 year period. Clean energy tax incentives. The OBBB eliminates many of the Inflation Reduction Act's clean energy tax incentives for businesses, including the Qualified Commercial Clean Vehicle Credit, Alternative Fuel Vehicle Refueling Property Credit, and SEC 179D deduction for energy-efficient commercial buildings. The law accelerates the phase-outs of some incentives and moves up the project deadlines for others. The expiration dates vary. For example, the Commercial Clean Vehicle Credit can't be claimed for a vehicle acquired after September 30, 2025, instead of December 31, 2032. But the Alternative Fuel Vehicle Refueling Property Credit doesn't expire until after June 30, 2026. Qualified Opportunity Zones. The TCJA established the Quality Opportunity Zone (QOZ) program to encourage investment in distressed areas. The program generally allows taxpayers to defer, reduce, or exclude unrealized capital gains reinvested in Qualified Opportunity Funds (QOFs) that invest in designated distressed communities. The OBBBA creates a permanent QOZ policy that builds off the original program. It retains the existing benefits, and also provides for investors to receive incremental reductions in gain starting on their investment's first anniversary. In the 7th year, taxpayers must realize their initial gains, reduced by any step-up in basis, the amount of which depends on how long the investment is held. The first round of QOFs available under the permanent policy will begin on January 1, 2027. The OBBBA also introduces a new type of QOF for rural areas. Investments in such funds will receive triple the step-up in basis. International taxes. The TCJA added several international tax provisions to the tax code, including deductions for foreign-derived intangible income, FDII, and global intangible low-taxed income, GILTI. It also established the Base Erosion and Anti-Abuse Tax, BEAT, on U.S. corporations that 1. Have average annual gross receipts greater than or equal to $500 million for the prior 3 tax years, and 2. Have made deductible payments to related non-U.S. parties at or above 3% of all deductible payments. The OBBBA makes permanent the FDII and GILTI deductions and adjusts the effective tax rates for FDII and GILTI to 14%. It also makes permanent the minimum BEAT, increasing the tax rate to 10.5%. These changes take effect beginning in 2026. Employer tax provisions. The new law makes permanent the exclusion from gross income for employees and from wages for employment tax purposes for employers for employer payments of student loans. It also provides that the maximum annual exclusion of $5,250 be adjusted annually for inflation after 2026. In addition, the OBBBA permanently raises the maximum employer-provided childcare credit from 25% to 40% of qualified expenses, up to $500,000 per year. For eligible small businesses, these amounts are 50% and up to $600,000 respectively. The maximum dollar amount will be adjusted annually for inflation after 2026. The OBBBA also makes permanent the employer credit for paid family and medical leave, FML, after 2025. Employers will also be allowed to claim the credit for a portion of premiums for paid FEL insurance. Employee Retention Tax Credit. If you filed an Employee Retention Tax Credit claim after January 31, 2024, you may not see your expected refund. The OBBBA bars the IRS from issuing refunds for certain claims submitted after that date. It also gives the IRS at least 6 years from the date of filing to challenge these claims. Miscellaneous provisions. The OBBBA increases the limit on the business interest deduction by excluding depreciation, amortization, and depletion from the computation of adjusted taxable income, ATI, starting in 2025. The deduction is generally limited to 30% of ATI for the year. The new law also makes permanent the excess business loss limit, which was set to expire in 2029, and it permanently extends the new markets tax credit, which was scheduled to expire in 2026. What's next? Since the OBBBA is simply extending or making relatively modest modifications to existing tax law, it probably won't result in the years-long onslaught of new regulations and IRS guidance that followed the TCJA's enactment. But we'll keep you informed about any new developments.